Leveraged ETFs, friend or foe? This video I've been meaning to create for quite some time, all around how leveraged ETFs work, how you should or shouldn't trade them, all of that good stuff. So before we get started, of course, it's not financial advice. Take this as purely educational only. So what are we going to cover? Number one, the mechanics behind how they actually work. Are they suitable to trade? And then we'll cover things like volatility, decay, daily rebalancing. What does it all mean in very simple terms, not fancy Wall Street speak? Now, heads up, this is the kind of video that is heavy on the math and the numbers and things like that. It's how we understand these instruments. It might be one that you want to hit that save button on so that you can come back to and rewatch a few times over. Before we get started though, the 50K Club, this is my community for options traders to create a consistent monthly income without needing a 7-figure account. We go a lot into the mechanics of trading. How does it actually work? How can you do your own research? How can you use things like leveraged ETFs, among many other things? So if you're interested in that, the link is in the description. Come join us. We would love to see you there. All right. Before we get started on the whats and hows, ponder this for a moment. February last year, right up here, right? This was the tippy top of the market before we had the crash related to tariffs. Now, I've purposefully chosen this area to show you these examples. Question: if you had 10 grand to put it in QQQ right before the top, right at the top, today you could have a return of either 26.97% or around 42%. What would you prefer? SOX, the semiconductor ETF, same point in time, just before the tariffs crash, and as of now, you could have a return of either 131%, 142%, or nearly 350%. What would you prefer? Robinhood. Now, Robinhood, if you put the same 10,000 in, you could have a return of either negative 5.5% or positive 72%. And my last one, Amazon, at the exact same time as well, February of last year. As of today, you could either be up 1% or down 31%. Now, this is all using leveraged ETFs, right? The leveraged ETF versus the just regular stock. So my question is, how does this happen, right? How can Robinhood be up so substantially, but Robin, the ETF, be down even more? Whereas QQQ is up a bit, but TQQQ is up much more. And the reason behind this, it's all to do with the daily reset and volatility decay. Now, this is a key point that I had to understand in order to figure out, well, if Amazon is down 20%, why isn't the 2 times leverage version down 40%? Or if QQQ is up 20%, why is TQQQ, the 3 times leverage, not up 60%, right? As we go through today's training on this, everything that I talk to is just using 2x as the ETF because it's easy math. So leveraged ETFs are designed to give you 2 times the exposure and the daily return at all times, not 2 times the returns for infinite ownership. This is what we're going to cover first. So 2 times returns. If we were looking at receiving 2x returns at all times, that would effectively be the same as using margin, right? So example, if you wanted 2x returns, you could buy $200 worth of shares, 100 in cash, 100 in margin, and your initial investment would never change, right? You're in it for 200 no matter what happens. That $200 doesn't change. If the stock moves up by 10% over a period of time, you'll be up 20% on your cash investment. If the stock moves down 10% over a period of time, you'll be down by 20% on your $100 cash investment. So that's 2 times returns at all times. 2 times exposure at all times is your daily reset. Okay, so think about it this way. If the stock is trading at $100 and the 2x ETF has a current value of 20, the 2x ETF needs to hold $40 worth of exposure, right? So that it's got twice the value. So think of this as technically your margin, right? You want 2 times worth of exposure, so you need to hold $200 worth of shares rather than 100. I'm not going to go into how it gets its exposure, but for ease of things, just in your mind, think about it as though they're buying and selling shares. It makes it easier to understand. Now, if that stock goes up by 10%, the ETF goes up by 20%. So it started at 20, it's now worth $24. It's up by 20%. The daily reset means that the fund now needs to increase its exposure to $48 to keep up with the 2x exposure. So at the end of that first day, the fund is buying more to increase its exposure, right? Because it only had $40. Now it needs to buy more so that it's always got 2x exposure. Here's kind of how it works. So again, just follow it through, right? The stock's 100, a 2 times leveraged ETF is trading at $20, and the ETF price, it doesn't matter, right? The math works out the same. So we start with $20 as our value. We increase by 5% the following day. That 2 times ETF is now trading at $22. The actual fund behind that needs to rebalance so that it's got $44 worth of ownership of the underlying stock. Okay. And so on and so forth. The next day, we rise another 5%. We now have our ETF value has gone up by 10%. So it's now worth $24.20. The fund needs to buy a bit more and be worth or hold $48.40 worth of exposure, right? The next day, the stock falls. So the stock itself falls by 4%. Our 2 times ETF falls by 8, right? So it's gone from $24.20 to $22.26. It can now only hold $44.52 worth of exposure, 2 times what its value is. So it's selling on this day. Okay. Now, daily rebalancing doesn't actually affect how the ETF performs for you and I, right? It's just understanding what it does behind the scenes. So think of it like the S&P 500 rebalancing. Stocks enter and exit and the ETF needs to buy and sell. If one stock value increases or decreases too much and the portfolio isn't balanced, again, the ETF needs to buy and or sell. This happens quarterly, whereas the leveraged ETFs are happening, they're doing this daily. My next question when I was properly learning about these, well, how does it actually only move 2 times, right? Like, we're physically buying and selling this thing. What's keeping it pegged, if you will, to that 2x move for the day? In short, there's what's known as authorized participants. So think of these guys as the market makers. They're either creating or buying shares to help keep the price stable when they notice that there's a discrepancy. And there will be. It's not perfect by any means. It's not always exactly 2 times the move for the day, but authorized participants are sitting there watching when there's a discrepancy and either creating more shares or buying them to keep that 2x move for the day relatively clean. So then the question becomes, how do they drift from the underlying stock? How do we get something that looks like this, where Amazon is up by 1%, but AMZU, the 2x leverage, is down by 31%? How does that even happen? Because we've just been through the process of, but they move the same percent every day. So why does this discrepancy happen? And this discrepancy or the drift happens to both the up and the downside, right? If the underlying only or mostly goes up, then we're actually going to end up more than 2x up. And it's simply due to compounding. This is where it gets a bit mathy, right? Let's say that we had a 15% increase in the underlying stock over 10 trading days. Now, for the ease of math, I've assumed here that the value of the actual underlying index or stock is 100, and so is the 2 times ETF. We know that that doesn't actually, it's not the way it works, but the math works out exactly the same whether we're starting the ETF at 100, at 20, at $36.12, right? This number doesn't matter. The math still works out the same. So when we're predominantly increasing, we can see what happens here is the index value return is 2.2%. We go up by 2.2%. The 2x ETF goes up by 4.4. Great. This part here, same. But it's literally from the very next day. We go up by 1.8%, which takes us to our 104.04. We go up by 3.6%, which takes us to 108.16. Now, because we're moving or we're increasing from a higher base now, 4.4% or 3.6% off of a higher number here than here is going to compound faster, right? Take a screenshot of this if you want to come back and kind of look through the math. But the final results, after mostly going up, we've got a few teeny tiny little negative days. The index has moved up by the 15%, but the 2x leverage has moved up by 31.9%. And it's all to do with the fact that the number is growing faster. We're compounding our returns from a higher and higher number as we go, right? Because as we can see here, the underlying stock increased by 2.2, $2.20. If we were to have double that increase, it would be $4.40, right? That's exactly what happened because we started from the same place. However, as time goes, where in this instance between day 5 and 6, we had a increase of $2.15 on the underlying stock. 2 times that increase would be $4.30. But the actual return that we got, the difference between our 115.82 and our 120.46 was $4.64 because we're starting from a higher base, right? Now they drift both to the upside and the downside. We know that. So if the underlying stock only or mostly goes up, then we end up more than 2x. The opposite is true if we go down. We then end up less than 2x down if that's the majority of the move because of the same reason. So how does this work out? So let's look at a 20% decrease over 10 trading days, okay? Same scenario. We're starting with a value of 100 on both the stock and the 2x ETF. So when we lose 2% on the stock, we drop down to $98. Losing 4% on the stock, we drop to 96, right? Then we continue to drop by all of these negative numbers here. What happens is at the end, the actual underlying stock is now worth $80. We can see that here, which is our 20% loss. Now at a 2 times total return, we could expect that 2x leverage ETF is down by 40%, but it's only down by 36.4, right? Why? Because now we're losing our value based off of smaller numbers rather than larger numbers. How that works? We start at the same place, right? We'd go from 100 to 98. That's a $2 decrease. Times it by 2 for 2 times the daily return. It's a $4 decrease. takes us to 96. Fast forward to day 5 and 6, we lost $2.79 on the underlying here between 90 and 87.21. A 2x return on that would be $5.58 negative. But the actual loss was only $5.01. Why? Because we're starting at a lower base, right? We're starting from only $80 instead of $90. So because of that, our overall returns at the end of the downward movement are lower. So then we're asking, like, well, what's the problem? If we're rising more than 2x when we go up, and if we're dropping less than 2x when we go down, what actually gives us the results like this? Because this is not less than 2x. This is like 30 times more than 2x. Volatility. And volatility, in other words, is just lots of ups and downs with no real direction. And as you can see, Amazon went essentially nowhere since February of 2025, right? It's up by 0.98%. AMZU, the 2x leverage, down by 31%. So how does volatility affect us? It's through this same mathematical equation, right? This is a very extreme contrast. We're not going to have a market that goes up by 10, down by 10, up by 10, down by 10, right? It's going to be a different fluctuation, but this is just so you can see the math behind it. Because what we said was true on everything else that we just looked at, where we're going up at a higher rate and down at a slower rate. When we get this kind of movement, it's working in the opposite direction. We're coming down at a faster rate and up at a slower rate. Let me highlight this part. So again, starting at the $100 mark, we gain 10%, we move to $110. The 2x leverage goes up by 20%, it's now at 120. When we lose 10% off of 110, we drop back down to 99, right? Not far from where we started. But to lose 20% off of a higher number, the 120, we're losing more, right? And we're now $4 away from where we started, whereas the underlying stock is only $1 away from where we started. We then gain our 10% and we're up a bit. We gain 20%, but we're not up 20% from where we started, right? Following all of this through, how we end after our 10 trading days, the stock will be down by about 4.9%, right? It's dropped from 100 to 95. The 2x ETF is down by over 18%, right? That's not 2x, that's substantially more. And it's because 10% down does not need 10% to get back to base, right? A 10% drop requires an 11.11% recovery to get back to base. So running that through, $100 minus 10% drops us to 90. If we were to just say, oh, well, we dropped 10%, we need 10% to get back there. No, 10% on 90 is only going to get us to 99. If we take our 90 and we go up 11.11%, we're back at our 100. So bringing in our leveraged ETF to this, 2x leverage would have dropped 20%, right? If we're dropping 10% on the underlying, the leverage ETF would drop 20. When you drop 20%, you need a 25% increase to get back to the 100. But 2 times 11.11 is only 22.22. And this is how we drift so violently between stocks that just go up, down, right? Because the regular stock will recover on this move, whereas the ETF will lag. It'll catch up if we continue to get more and more and more upward moves without the downward moves. It'll catch up, but it needs those uptrending moves to be able to catch up. So volatility. Let's come back to the chart that we just had. On day 8, we're at 96.06, whereas the leveraged ETF is at 84.93. To get from 96.06 to 100, the stock needs a move of about 4.1%. 2 times that move would be 8.2%, right? For our leveraged stock that's currently at 84.93, if we're getting a 2x return, so 8.2% move, we're only going back to 91.89. So we actually need a larger move. We need a 17% move, nearly 18% move to get back to 100. So it needs to move, what's that, 4, 8, 16. It needs to move more than 4 times the amount of the underlying stock rather than 2. I know this is a lot to get your mind around. So I hope this is helping you to sort of visualize it a bit. Now, this happening for, a couple of days is neither here nor there. But the longer the stock bounces for, the wider this gap gets. So we're recovering in smaller increments because we're starting from that lower base. Because of that, we need a long run of bullish days to really get that recovery. Take, for example, Robinhood. So Robinhood, from its all-time highs, is currently down 60%. In theory, its leveraged ETF, Robin, it's not currently down. That's the move it needs up. It needs a 60% move to get back to all-time high. In theory, its 2-time leveraged ETF, Robin, would need a 120% move. But it's done a lot of up, down, up, down, up, down, up, down, trending literally sideways. The move that Robin needs is 370%, which means if you even just half that, the move that you need to get on Hood is basically 120%, if not more, for Robin to get back to these levels, because we did up, down, up, down, up, down, up, down, right? So the next question that gets asked, can they get to 0? And the answer is usually no, right? And think about the math behind that. So for an ETF, a 2x ETF, to lose 100% of its value, the underlying stock would need to drop 50% in one day, because 2 times 50 is 100. Because of the daily rebalancing, getting to 0 is not usually mathematically possible without single day drops that exceed the leverage. So that exceed this ratio of 50%, 100%. And it's because you'll always have some value, and then you're gaining and losing off of that remaining value, right? So take, for example, the biggest move that I think the stock market has had in the last couple of weeks is IBM. So IBM's stock dropped 25% in one day. What happened to the leveraged ETF? That was down 50%. So it's still not near 0, right? It's still got plenty of value left in it. And even if we get another 25% drop from here, then the IBX, the leveraged, would drop by 50%. So it would come down to $8. So there's still some value there, unless the stock has a drop of 50%. In that case, trouble, right? The other thing to note here is you can already see the effect of the up, down, up, down, up, down. So IBM has gone right back to where it opened on this first drop, right? Whereas IBX still has a little bit of recovery to do. It's halfway up that candle rather than rather than at the top of it. So already we can start to see that this sort of all but sideways movement through here has caused the leveraged ETF to decouple, if you will, from the initial stock price. So with all that said, how do I trade leveraged ETFs? Now, for me personally, I typically avoid individual stocks because individual stocks have less certainty of up, 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 up. If you do want to trade individual stocks, you absolutely can, of course. This is very much a case of you do you, but make sure it's on a strong move and hold just for the move to be safe. So I like to trade leveraged ETFs. So ETFs off, for example, the Qs and SOX, because upward drift is your friend, right? I also don't buy options on them. That's essentially leverage on leverage, but I definitely sell options on them. I also like to buy the shares and then swing trade and or sell covered calls on the shares. And against, traditional, if you will, advice, I also buy and hold. I've just started this and I've started with TQQQ. There's someone that I found on TikTok. His name's Henrique. You can just literally Google Henrique leveraged ETFs and you'll find him. But he does the math around this and he talks about it and it makes a lot of sense to me. Like we saw in the initial videos, if you bought QQQ and TQQQ at the highs of February 25, you rode all the down and all the up. Yes, you're not 3 times up with TQQQ, although it's a 3x leverage, but your money in TQQQ has outperformed QQQ. Take that as you will. Again, not financial advice, just what I like to do. So, I hope this has kind of given you a bit of clarity around how they work and why they don't just always follow 2 times what the underlying stock is doing. I hope, if anything, it's given you more confidence around trading them, how you can, when you might be able to, when's a good time to avoid. If you've got any questions around them, absolutely leave them in the comments. I would love to hear them. And of course, if you want to dive into things deeper, if you want to get clearer on other strategies and ways to trade options, especially on a smaller account, come join the 50K Club. I've left the link in the description. We have a lot of fun in there and we would love to see you. All right, I'll see you all in the next video.